Good morning, everybody. It's 11 o'clock, so we're going to get on with things, I think. Our guest this week is Luciano Suana from Menhaden. And before we get to talk to him, I'll be running through a bit of news. There's not really an awful lot that happened this week, to be honest. I want to look at Aberdeen New Indy just because I'm going to be seeing the manager next week, I think, so I'll probably write something a bit more detailed. But I was really surprised to see how well it's doing at the moment relative to everything else. So here is the chart, and it's a nice sort of start in this corner and go up that way. So it's obviously been performing quite well, but the discount is stubbornly wide, so still about 18%, and it is a decent size. Here it is in the context of the rest of the India sector. So you can see that that discount is a little bit narrower than JP Morgan's. The top one on here is Ashoka, and that is reflective really of the performance that Ashoka has been delivering. So that's well ahead of everybody else over the sort of longer term. But more recently, just over a year, Aberdeen is now the sort of current pack leader. And that's quite strange because it was for a long time India Capital Growth. So I would sort of thought, let's have a dig around into this and find out why. Here you can see that the mid-cap stuff that the India Capital Growth Fund has been focused on has been outperforming, and the MSCI India, which is more like the Aberdeen and JP Morgan portfolios, has lagged it a bit. Obviously, they're still doing quite well. And here are Aberdeen New India's returns, sort of broken down cumulatively. Decent positive absolute numbers, but relative, it had a really quite disappointing period here between about sort of 2020 and 2023, mid-2023. And it's only recently that it sort of picked up a bit. So even though it's done very well, it's only just managed to beat the MSCI India over the last sort of 12 months. Now, this is the interesting chart because this is what sort of foxed me really, because you can see that everything was sort of moving quite predictably until we get to about here. And then these are relative charts. So MSCI relative to its benchmark had a little dip down and then shot up, and it's been outperforming. The India Capital Growth Fund fell off a cliff and is still falling. Obviously not great, and that's relative to the S&P BSE mid-cap. Now that sell-off in mid-caps was triggered by regulatory investigations into a whole bunch of different things, but it seems that India Capital Growth has ended up caught with some of these more speculative stocks that where the prices were too high and they've been hit quite hard by this. And then we had the dislocation from the election. So that ran on for quite a long time. And the result wasn't quite what people were expecting. So that caused a bit of instability in the market too. So there's initial kind of like market fall. Then people said, actually, it's probably going to be sort of business as usual. So it sort of bounced a bit. In terms of what the new India managers are saying is that they think that the sort of basic reform stuff that's been going on, the put money into infrastructure, support manufacturing, support technology, that's going to carry on going. But they don't expect to see any more really radical change, the sort of things that Modi did when he introduced that sort of VAT type thing, for example. But the reason they probably lost the election, partly it's rising income inequality, which is true the world over, but in India particularly, it's because there's rising unemployment among the youth, and also particularly in rural areas. So they probably need to sort that out, which is be a bit more sort of populist. So expect that sort of stuff to continue. Basically, what we're talking about is the government supporting the continued growth of the economy, and it's the fact that India is growing so much faster than anything else that's sort of been driving this. India is expensive too. So here we look at it relative to China, rest of emerging, which is obviously heavily influenced by those two things. So India is now the second biggest component of the MSCI, measuring 1%. India is about 18%. And that's obviously a chunk of the world index, which is dominated by the US. I mean, those stocks in the US are expensive too. But nevertheless, India, it really is looking quite dear. So these companies that are in there need to carry on generating the above normal growth that they have been doing to justify those kind of ratings, and that's what's going to make the market more volatile going forward, I think. So it did announce results this morning, and that's obviously what triggered this. And in the period that we're looking at, it actually lagged the index. So that sort of shift to outperforming has only really happened in April and a bit of May since. Sorry, yeah, and the discount didn't really move, even though they bought back a lot of shares. And so I think they've got a big job to do in terms of trying to convince investors that they want to back this thing. But I do think that India is quite an important market now because of what we've been saying. Because it's growing so much faster than China, because it's increasingly important within the emerging markets, I think it is going to be somewhere to focus on. They have rejigged things a bit, so they've changed the structure, the management structure a bit. So Christy Fong's stepping down, James Thomas now lead manager. He's got a new assistant. They're putting a bit more kind of mid-cap focus into the portfolio because it's just a bit too much like the benchmark. So they're making it a bit more active relative to the index. And they're also going to be able to put up to 10% of pre-IPO investments because there have been quite a lot of things coming to the market. And again, this is what another area of volatility and one of the things that Indicator Growth was doing quite well out of, and then it's fallen back since. So whether it actually takes advantage of these things, we'll just have to wait and see. But they do have to get on with things. If they don't, there's this conditional tender offer coming. So they sort of guaranteed to probably lose a quarter of the fund if they carry on underperforming. It's measured over a 5-year period that doesn't end until March 27. It's based on the NAV adjusted for the capital gains tax, because obviously you can't actually quite track the index as any kind of manager because there's capital gains involved. But they have got a bit of a catch up to do. So 2 years into this measurement thing, they are 5.7% percentage points behind the target. So they do need to do something about this. So I do think this is an interesting fund, and that 18% discount is too wide if it carries on doing relatively well compared to everything else. Last, just very quickly on Asia Engine Impact, because it is really the last day of it existing. There's a vote today. It's almost certainly going to be liquidated. Just if you are an investor in this, it's obviously trading on a massive discount, about 20 cents per share. The NAV is now only 45.6. It looks like they've got enough cash to pay an 11.4 cent distribution by the end of July. So a big chunk of what the current share price is going to come back in cash. But then the next chunk won't really come until they've sold the rest of the portfolio. And they say that the process is well advanced, but obviously that doesn't mean anything really. So anything might happen. So you could be waiting a few more months for more, but we'll just have to wait and see. The thing that crashed the fund and the thing that caused all the problem is this solar project, ROMS. So they had to put another $4.5 million into that to keep the whole thing going. Otherwise, they were going to trigger some penalty things that would have taken out another big chunk of the NAV. So they've done that. It should be operational by the end of the month, but as there's always these things, if something goes wrong, everything goes wrong. There's stuff that the landlord's got to do for the big site, and that hasn't been done yet. So that's almost certainly going to be delayed. And how long it's going to be delayed, I don't know, but it could be some time by the looks of that. And so it's probably going to need some more cash. They're saying about another $1.2 million. That 1.2 million, they've already got that because the cash that they've got is a lot more than that 20 million. So I think it's about 33, and they're holding back a chunk of it to cover the expenses of the fund going forward and this. So that's what's holding that up. So it will get wound up, but you're not going to get your money back in a hurry. So that's enough from me. Let's talk to Luciano. Good morning.
Good morning, James.
Thank you very much for doing this. So as usual, I'm going to let you tell us a bit about the fund first, and then we'll get on to some questions from the audience, please. And if you want to ask a question, just put it into the chat box in YouTube, please. Thank you.
Perfect. James, can we go to page 4, please? So Menhaden was set up in 2015, in July 2015, by Ben Goldsmith, Graham Thomas, and Alexander Vavalidis. The fund was set up as a kind of a mix of a fund of funds. The management of the equities part of the portfolio was outsourced to Web, which Ben had previously found. And it's a closed-end investment trust, and it focuses on resource efficiency. I joined Menhaden in March 2016, and Edward Pybus, which you can see, our analyst, joined in early 2018. Ben, I think he probably doesn't need any introduction. Member of the Goldsmith family, passionate of the environment, and you know, a finance entrepreneur. He's set up a few different businesses in the investment management arena. Graham was the executive, the chair of the executive committee of RIT, so very familiar with closed-end investment trusts, and I work in different positions in investment banking and joined Menhaden in March 2016. Can we go to page 7, please? So that's effectively Menhaden. We're a long-only closed-end investment trust. We focus on capital preservation. We tend to be very concentrated with 15 to 25 positions. Some of our highest convictions idea tend to have, you know, to be larger than 10% of NAV. And we focus mainly on developed markets. We have invested directly in Brazil a couple of times, but mainly because we've seen deep value, and I work there, and I have some contacts, and they work pretty well, especially one private deal that we're going to talk about later. Can we go to page 9, please? So when Menhaden was set up, I think they were in a rush to invest, and I think they got involved in some kind of binary outcome positions that didn't work out. The lessons that we learned was that we should focus on quality, and we came up with this 3 Venn diagrams, and we're looking for the intersection of those 3 Venn diagrams. Basically, the intersection of resource efficiency, quality, and value. And we understand value as basically the companies where we see interesting valuations, and we see a path in terms of revenues and EBITDA and profitability, where we see high degree of certainty. For us, quality, we focus on market structure. So we are very, very focused on companies that they are the leaders in their sectors, and they have big moats, and we have high certainty that that disruption is not going to happen. Can we go to page 11? So that's the portfolio. Currently, Menhaden has more or less around 80% in listed in cash and 20% in private deals. The private deals are mainly co-investments with the best private managers in the world. We invested 4 times with KKR, once with Apollo, and we are co-investing with in the TCI fund, Real Estate Credit Fund 3 and Real Estate Credit Fund 4, which are very interesting private credit setups where you get very, very high returns and with very low risk. In the listed portfolio, you will see that we have approximately around 50% in the likes of Alphabet, Safran, Airbus, Microsoft, and Amazon. Those are, let's say, the companies where we have operational leverage, and the rest of the portfolio is mainly infrastructure with Vinci, Canadian Pacific, Canadian National, Ocean Wilsons. We like very much the technology component of the portfolio with Alphabet, Microsoft, and Amazon, because we see a high degree of predictability with the growth in cloud, and the adoption of new technology, and obviously also AI. But in terms of valuation, we feel very comfortable with them. We see close to around 10% IRRs with Alphabet, and Microsoft and Amazon. Perhaps with Alphabet, we're being a bit conservative. You probably will end up with much higher numbers than that. But we think that easily we can get more than that in the case of Alphabet. For the rest of the portfolio, Airbus and Safran, it's very interesting that Airbus basically has a backlog of 10 years. So this high degree of high predictability of revenues and earnings. The main issue in this case is like they have to deliver. That we see that they are going to produce approximately 75 planes per month by 2026 in order to meet that demand. And it's basically a duopoly with Boeing, and Boeing is in a very difficult position at the moment. In the case of the Safran, similar, they basically have to supply. They provide the maintenance and the spare parts for the aircraft engines. The aircraft engines market it's another oligopoly. Basically, you end up with the JV between Safran and GE, Rolls-Royce, and Pratt & Whitney. And we believe that the Safran and GE are the best operators. For the infrastructure part of the portfolio, Canadian Pacific, Canadian National, and Union Pacific, they are effectively regional monopolies for in the railroads in North America, and it's virtually impossible to build a new railroad. You can basically add small segments to different parts of the country, but you cannot create a new railroad operator because of environmental concerns. So it's unlike the European infrastructure operators where you buy the concessions for a limited amount of time. In the case of the Canadian and North American railroad operators, you own the tracks. So it's a perfect hedge against inflation. We see IRRs of approximately around 10-11% with them going forward. Until very recently, the story with them was efficiency. I think the marginal gains going forward in efficiency are going to diminish, but it's quite likely that the story now will move towards volume growth due to the reshoring of industrial capacity to North America. In terms of the private deals, we just co-invested with KKR in this new deal called Avantus, which is a solar developer in North America, mainly in California and the southwest of the US. It's an opportunistic deal. We see very high IRRs, close to 20%, and potentially even higher if they manage to sell the developer platform to an established operator that finds interest in that. So just basically looking at the assets, we think we get at the 20% IRR. And we know that this high degree of, demand for electricity going forward because of obviously data centers, electrification, so very low risk there as well. The TCI Real Estate Credit Fund 3 and 4 are very interesting because, as I mentioned previously, you get IRRs that are equity-like. They are targeting 10 to 12% returns, and the risk is very limited because of the low loan-to-values. They tend to lend to very, very good established developers with that own basically trophy assets. Let's say a Four Seasons hotel in New Orleans, and where the majority of the risk is for residential and hotels. They don't get involved in office space or retail. I think we could move to page 14. So here's a list of the private realizations that we have in Menhaden. ADO was a real estate play, residential apartments mainly in Berlin. That was a co-investment with Apollo and through the Goldsmith family office. One of the things I didn't mention is that we usually get preferential terms in all these private deals, thanks to Ben's contacts. In the case of ADO, we pay zero fees for this co-investment with Apollo. Callison was a operator of smart meters in the UK with KKR. It was a very successful transaction. We got a 15% IRR. Perfin Apollo was a developer of transmission lines in Brazil. It was our best ever investment. We basically quadrupled our money in the space of less than 3 years. Exilio was a very similar deal to Avantus. It was a co-investment with KKR, again through Ben's contacts. We exited in November 2023 when the company was basically sold to Brookfield. A very decent IRR of 13% in dollars. And then again, this, I think we always said that we're going to invest in privates when we see that the returns are compelling and more attractive than the public markets. Until very recently, we were finding quite difficult to find interesting private deals because a lot of the deals where we saw decent IRRs, where the returns were predicated upon high levels of leverage. But recently we're starting to see again good returns in private markets, and that's the reason why we invested in the Avantus deal that represents approximately 10% of IRR now. Sorry, 10% on NAV now, sorry. And we see an IRR of around 20%, and there's some interesting risk features as well. If we don't, there's a put to the one of the developers, one of the owners as well, if the certain metrics are not met. So we think that the risk return is very, very compelling. But it's very difficult to find very good private deals, and we believe that our public portfolio is very high quality. They are basically monopolies and oligopolies, and established businesses with very low levels of leverage. And in the case of Amazon, Alphabet, and Microsoft. They basically monopolies in their own sectors. Airbus and Safran. Airbus is a duopoly. Safran oligopoly. And the railroads and the infrastructure parts of the portfolio are basically undisruptible. Can we go to page 15, please? So this is the story of Menhaden. I think, as I mentioned at the beginning, the fund was launched in July 2015. They were quite eager to deploy very quickly. Perhaps some of the positions were didn't work out. So since we kind of rebuilt on the quality, I would say from March 16, from April 16, the portfolio, we reconstructed the portfolio towards the current type, where with intersection of quality, value, and resource efficiency. And things have been working. We've been compounding at 11% since, net of costs. And we see very compelling returns currently at NAV level on the portfolio. And obviously with the current 40% discount, which seems completely ludicrous, provided we manage to narrow the discount to more acceptable levels in the next few years, we think that that investors that believe in us will be handsomely rewarded. We are very aligned with the concert party of Ben's family and the rest of us. We own approximately 29% of the trust, so we're fully aligned with investors, and we think that if you own Menhaden now, you won't be disappointed. I think that's the overview, and obviously, again, I would reiterate the access that you get investing with us. I think I've never met anyone as well connected as Ben, and I think it's a great feature that we have, that we can access all these private deals and with preferential terms, and I think that's a very strong differentiator. Plus, obviously, the quality of the public portfolio and the fact that we are fully aligned, I think it's should make investors comfortable with Menhaden.
Thank you. That's interesting. Okay, so let's think first then. Where are we? Here we go. How do you decide the split between quoted and private? What's the sort of limit that you let the private get to?
Well, we always said that when Menhaden was launched, effectively, if you look at the prospectus, Menhaden could be up to 60% private. But we decided very quickly that if you end up with lots of privates, people will subscribe discounts, very high discounts, and we thought that wouldn't make sense. And we said that basically we would never expect the privates to be more than 40% of the portfolio. But it's not that we are actively looking and we have to put 40% because that's the magic number that we're seeking. It if we find deals that provide better risk returns than the public portfolio, we will increase the privates, but no more than 40%. The issue that we find is obviously, as I mentioned, that the public portfolio, we're talking about monopolies and oligopolies with very high entry barriers, very good businesses with low levels of leverage and high visibility of earnings and revenues. It's very difficult to find deals that can meet that criteria. And why should we reduce Alphabet and Canadian Pacific or Microsoft if we have high certainty that we're going to get to a 10, 11% IRR in the next 5 years. So, in the case of Avantus, we saw that there's these risk mitigants. We saw that, it's quite likely that we're going to get at least a 20% IRR. And then we said, okay, in this case, it makes sense, right? And then we took some money off the table at all-time highs in the portfolio, and we redeployed let's say at a lower multiple with a higher IRR.
Yeah, fair enough. The private sector you got there, is that the whole amount that's invested, or is that including commitments as well?
That excludes commitments. There's a further $15 million to go on the TCI Real Estate Credit Fund 4, but historically they never been able to fully deploy the commitments, and it's they tend to land at between 12 to 14%, so it's very expensive money, and we don't expect that they're going to fully draw. But you could assume that maybe another $5 to $10 million potentially could be invested there. But it's a very safe and low risk type of asset. They never lost money in any of their investments because of the risk mitigants that I mentioned, the low loan to values, and they tend to buy only super high end, spectacular locations and kind of trophy assets, mainly in the US and to a small degree in Europe.
Okay. Let's talk a bit more about Avantus. So this is new solar farms, yeah. So it's going. Has it got a portfolio of sites secured already?
Yeah. It's all basically. I think you can assume like 60% of the portfolio is already up and running, and their businesses they develop photovoltaic. Basically, and then they sell once it's operating to people that require low IRRs, like a pension fund or an endowment fund in the US. So it's very similar to the strategy that we had with Exilio, another co-investment with KKR, which was another solar developer. But in terms of jurisdictions, it was based. Exilio had a lot of exposure to Spain, Japan, whereas in this case, Avantus is mainly a US play.
And within the US, is it focusing on states where you get the extra tax credit because of they're economically deprived, or
Yeah, but we in our assumptions, it's basically you can see that you get to going forward to very competitive returns by even not looking at any extra cash from subsidies, etc. It's the interesting thing now is that PV solar is the most competitive source of energy right now, right? I think there were issues obviously when Spain was doing that, of giving a premium that was like 5.25 times the average energy price. But that didn't make sense because you're basically making your mix way more expensive. But now the technology is so well established, and you keep seeing like increases in efficiencies every year, that the technology per se is the cheapest source of energy at the moment.
So changing government in the States, I mean, I know Trump's talked about rolling back on the Inflation Reduction Act, but I don't know whether he will do. I mean, what do you think that will have any impact?
Not really, because this PPE contracts, you basically they are long-term contracts where usually there's no way out. And I think from a lot of these companies, like the likes of Alphabet and Microsoft, they basically buy 100% of their energy from renewables. And then again, it's like, PV is the cheapest source of energy. So you can try to force coal as a new source of energy, but the problem is like it's like trying to reintroduce VHS or Betamax, right? It's like the technology is gone. It's not good, and all these companies have signed to the carbon disclosure project, and they are trying to reduce their carbon footprint. And it doesn't matter really what Trump says or does. So we're very comfortable with that.
No, fair enough. There's a few questions about this, but I suppose I'm intrigued because obviously we've got 2 listed funds in the sector that are supposed to be doing this that people have kind of rejected, and it's quite hard to understand why. Okay, let's move on then. The railroads, I'm intrigued by. So what's the driver of increased profitability there? Is it more and more freight traffic on the system? Is it more efficient?
Well, until as I mentioned during the call, the majority of the gains was done via efficiency, right? What they call precision railroading. Like it's increased. They increased the number of trains and the cargo, right? And then they could basically move from in the hubs. They can actually move certain parts of the cargo to another train, and then that's been done very efficiently, and that's been driven mainly by IT and technology. But they effectively, you can think of them as kind of real estate, right? It's like real estate. You're squeezing, maybe getting more money from different parts of the real estate. But going forward, we think that the majority of the gains have already been taken in terms of efficiencies, and now going forward, the story is going to be more about volume growth. And you can assume something like 4% volume growth, 2%, 2 to 3% like pricing power, like above inflation, and then another 2% of buybacks. So you get to like 9% growth algorithm in their case. And it's a very safe type of asset because it's 4 times more efficient than actually transporting goods by trucks, right? And way more, way cheaper, and a lot less CO2 involved as well.
Right. On that front, on the decarbonising them, is it possible to move to electric trains?
What we've seen, no, but there's a lot of new technologies that they are exploring. I think their CEOs have mentioned that capturing the carbon from even using diesel, or they looked at other technologies like hydrogen. But the problem in the US is like we're talking about such long tracks, right? I mean, it's such long distances that it's not unlike Europe, that you have high density of population everywhere, and especially in the case of Canada, that would be a bit way more difficult. But perhaps that's something that will be seen in places where you have more density, but then you have the issue of how you change technology. One part, you need 2 trains, let's say, right? So that's not something that we envisage or we heard from them, but at least they are heavily investing in decarbonizing the business, or at least decreasing the carbon footprint.
Okay, great. Ocean Wilson's is an intriguing one. So maybe you should, I know what it is, but maybe you should explain for the benefit of the readers what it is and why you hold it, please.
Yeah, Ocean Wilson. So Ocean Wilson is the main position of Hansa Trust, right? Hansa Trust, another closed-end investment trust. Ocean Wilson, effectively, it's like a closed-end investment trust. It has mainly two positions. One is a controlling stake in Wilson Sons, which is a Brazilian port operator and tugboat operator. And then he has a portfolio of investments of circa $300 million. The interesting thing is that, you know, it trades at effectively a 50% discount to NAV. And in a way, the way we see it is we get exposure to Brazilian infrastructure for free, right? Because of what I mentioned, that you have this kind of portfolio of investments, which it's perhaps, in my opinion, for my taste, is too diversified. There's something like 85 positions in the portfolio, and the performance has not been great. But you know, I mean, there's value there, obviously, and the fact that it trades at a 50% discount and you're getting close to a 5% dividend yield, and in our case, because you know, it's not like the dividends that we get from the US, where you end up with withholding taxes. In this case, it's like there's no tax leakage. And there's an interesting dynamic at the moment that supposedly they've been exploring the possibility of selling their stake in the Brazilian port operator. And we expect that if that happens, that could, you know, drive a massive increase in the share price and a decrease in the discount. So, but they announced this process like a while ago, and you know, there's not been any news, so we're kind of, you know, expecting, but maybe nothing will happen. But even then, we see like, you know, it's kind of a deep value type of position, and we kind of like, it's a great place to hide in the current market.
Yeah, definitely. It's a very intriguing one. I mean, there's a question that's just popped up here saying, why don't you buy Hansa too?
Well, precisely because I think I don't see the Hansa trades at a 44% discount. Ocean Wilson trades at a 50% discount. You're too far from the asset, because I think the Ocean Wilson represents approximately 20% of their of Hansa Trust. So even let's imagine that they sell the Brazilian asset. I mean, the discount narrowing will probably happen at Ocean Wilson, not at Hansa Trust, right? I think Hansa Trust the discount maybe will narrow, but by way less than in the case of Ocean Wilson, where, you know, effectively it's 50%, close to a bit more, but let's say 50% of their assets.
Well, that makes sense. I mean, I suppose the other thing that you think about looking at our sector is that there are a lot of renewable energy efficiency type funds trading on big discounts. Would you ever buy any of those, do you think?
Definitely, that's a possibility, but we are not. I think we invested in renewables previously, but we kind of prefer the developer types like the Avantos and Exilio, because we think that you end up benefiting from higher IRRs. If you just go and you buy, let's say, a PV solar deal, usually you end up with like much lower IRRs, right? Once it's operating, etc. Because this is the kind of price for this one. They are greenfield, brownfield, and then when they are operating, and you buy them once they are already producing cash. So we think that the best value is going at the beginning, like starting them from scratch, and then once they are fully operating, you basically try to sell them. And in the worst case scenario, if you don't sell them, at least you'll be benefiting from, you know, IRRs of close to like 15%. Whereas if you just go and you buy one of these listed yieldcos, and there's some very interesting ones in the US, for instance, with Brookfield and Atlantica. You just basically you're just sitting on a yield of maybe 9%, and we think that, you know, you're minimizing the risks if you buy a solid group that has experience developing, and you have a better risk return.
Yeah. And also, you, from a sort of environmental point of view, you're having more of an impact if you're developing new stuff.
Correct. But
yeah.
You know, the problem with real estate, with renewable development as well, is the fact that, you know, there's so many people getting involved into this now. Obviously, we know the demand is increasing, etc. But you really have to find the right partner. You shouldn't just go with any developer, because they need to have experience. They need to know what they're doing. You need to negotiate the contracts, and there's a lot of risk in those things, and usually there's leverage involved, so you have to be careful.
Fair enough. Can we delve a bit more into Safran, please, and just tell us a bit more about what's in that business and how it makes its money, and what you see the angle is there, please?
Yeah, so we like Safran mainly because of the engine manufacturing part, right? Which is the main value. That's like the majority of the value of the company comes from there. They also are involved in other parts of you know, they also produce like seats for aircrafts, and but the interesting part is the engines. The interesting thing with Safran is that the life of the product is very long, right? And usually they don't make money when they sell the engines, but they make money by selling the spare parts and the shop visits when they go to be checked, let's say. And so it's extremely complex, you know, to build a new engine. The new LEAP-1 engines are 20% more efficient than the old ones, the CFM 56, and it's the efficiency is there, right? The 20%, they emit 20% less CO2 and 20% we use less fuel. Potentially, you can use the sustainable air fuels that basically there's very little emissions with those. The problem is that they tend to be very expensive, but there's a lot of, you know, new regulation coming from Europe where they are increasing the mix of SAFs in, and they probably will increase from 2030 onwards. So we expect that air travel will be more expensive in terms of pricing, etc. But you know, there's basically no competition. You have the JV with Safran and GE. You have Pratt and Whitney, and then you have Rolls-Royce. And you know, it's a company that we see the visibility for earnings in the next 15 years is pretty clear, right? The same with Airbus. I mean, the Chinese eventually will come up with some products, but you know, apart from that, and we think that they probably will focus on their local market. It will take many years, right? And there's been also reports that the Brazilians, Embraer, is trying to get involved with building a competitor for the A320, but we think that, you know, it will take many years, and we don't believe that they have the financial muscle to do that.
Fair enough. One more stock I'd like to talk about, if you don't mind, is Vinci.
Yeah. Yeah, I think this quite interesting what's been going on in the last few days because of the election, the European Parliament elections. We've seen that the price has gone down to approximately 100 euros per share. Effectively now, that's the value of Vinci without the toll roads concessions. So you know, you can even subscribe zero value that they are going to nationalize the toll roads, and we still think that that's the price that you would get. And probably I think that the probability of nationalization of the concessions is very low, and if that happens anyway, the company will receive cash as compensation. So, you know, I think that the share price movement, it seems a bit over, you know, excessive. But that being said, you know, if Marine Le Pen wins, there will be more headline risk, and the price could go down further. Yeah. But we like the business very much. They are very good operators. They've been growing free cash flow around 10% for the last, you know, more than a decade. So it's a very well-run company. They recently bought ACS Industrial Services. The name of that unit was Cobra, and it's been a total success. Now they have basically the infrastructure part, which is toll roads and airports, and then they have the energy part, and then the contracting part, which basically is construction. We obviously like the most the infrastructure part and the energy part, and you know, it's a very safe company to own. That trades basically at around, you know, 11 times current earnings, and you know, it's a good dividend payer, and a very defensive stock to own.
Are you going to be adding to it then? And give us...
Look, we own a decent, you know, it's a chunky position for us. So I think we own enough. I think if there's a massive price movement because of, you know, people think that the risk is of nationalization, we probably will add. But I think that at the moment we have enough. There's no benefit from, you know, maybe adding another 1-2%. If we think that all the other companies, the portfolio offers similar kind of IRRs, but we just think that in the case of VINCI, it's perhaps the risk, you know, there's no disruption risk, and high predictability of earnings, etc. But yes, you can have some headline risk, and you can end up with, you know, maybe the share price could go down further by another, you know, 10%. Who knows?
Yeah. Okay, great. One last thing then. Let's talk about the discount, if you don't mind.
Yeah.
Do you say it's a bit dark?
Yeah, it's something that, look, I mean, I tried to come up with rational answers for this, and I don't know. I mean, what happened at the beginning before I joined, when the performance of the fund, that you know, they end up with like 30% discount. When I joined, I remember the discount was 30%, and basically it has been 30% for ever since, until very recently, when you know, we've seen that closed-end investment trusts in the UK, the discounts have widened. The issue I see is that, you know, we really want to decrease the discount, but when I see that discounts of like the likes of RIT at 28-29%, Caledonia at 37%, Hansa at 44%, so all comparables, all other closed-end investment trusts controlled by families. I think it's very difficult, right? Because we are way smaller than them, and but you know, I would argue that the quality of our portfolio is higher, our performance has been better, our risk is lower, and our portfolio of private deals, we don't go and decide we're going to buy a company. So we're talking about co-investments with the likes of KKR and Apollo and TCI. I think, you know, we think that we are much better than all of them from a risk return perspective, and we don't have leverage, right? Our cost ratio is similar, if not lower, to some of them. So, you know, I think we're doing what we can, which is focusing on performance, and we're fully aligned with investors, and that's what we can do.
That's really helpful. Thank you very much, Luciano. Thank you for asking all the questions. We'll obviously wish you all the best, and we'll follow with interest and get you back again in a year or so and see how things are going. But
thank you very much, James.
this morning.
Take care. Bye.
So we are back next week, and we've got this panel thing going on for just talking about big discounts. So I've got Nick Greenwood and Peter Hewitt and Ben Ritchie from Aberdeen. So obviously this is the big topic. We're just talking about it now. And discounts are way too wide in the sector, and so ways to address that is something that we regularly sort of need to look at. And so that's going to be the focus of next week's show. And then the week after that, we'll be talking to Nick Train from Principal Earth Income. And as I said before, we've got a full lineup of trusts for you. So have a good week, and we'll see you next Friday.